Imagine a strategy that beats the market average over the last 10 years, takes you literally 5 minutes to set up.
And requires absolutely zero financial advisors taking a cut of your money.
Exactly. Zero. I mean, it sounds like one of those late night infomercial promises, like call now and we'll throw in a free toaster.
You're on the Smart Capital School of Financial Literacy channel. It is great to be here to unpack this. And look, I get the skepticism. We are so trained to think that complex problems require these incredibly complex solutions.
Especially with our financial futures. But today, our mission is to decode this specific, simple investing guide designed for the 2026 economic landscape. We're looking at a 4 ETF portfolio that empowers you to just set it and forget it.
Which really is the ultimate goal here, moving away from micromanagement into a highly streamlined approach.
Right. Nobody wants a second job managing their retirement fund. But before we get to the 4 ingredients in this portfolio, we actually need to talk about the don't list. Because the source material kicks out some major traditional assets.
Yeah, it breaks some golden rules.
It really does. And the first casualty is bonds, which makes me a little nervous, honestly.
It's the biggest psychological hurdle for most investors. Traditional Finance 101 always says, you know, stocks are for eating well, bonds are for sleeping well.
Right, because when stocks crash, bonds are supposed to hold steady. They are the net.
Usually, yes. But the data we are looking at calls bonds, and I love this term, weak sauce.
Weak sauce. Very technical.
Highly technical. But the numbers back it up. Bonds are down about 5% over the past 5 years, and the deeper insight isn't just that they had a bad run, it's about why they are down.
Okay, so what's the structural issue there?
It comes down to the national debt.
Just that giant number that keeps ticking up on the billboard.
Exactly. When a country has these massive debt levels, foreign buyers start getting nervous. They stop buying that debt, which is essentially what bonds are.
And when demand drops,
the value drops. The source argues that unless you are predicting a massive, catastrophic 50% market crash, holding bonds right now in 2026 is just a drag on your performance.
It's like driving with the parking brake on, just in case you need to stop suddenly.
That's a great way to put it. I mean, in an inflationary environment, a safe asset that loses 5% isn't safe at all. You are guaranteeing a loss of purchasing power.
So you're losing money safely.
Right. So the guide says cut the cord.
Okay. I can follow that logic.
Yeah.
But the second rule break hits my diversification funny bone. The guide says no international funds, like specifically calling out the ETF ticker VXUS.
Yeah, the globalization argument.
Because I always thought you needed a bit of Europe, a bit of Asia, emerging markets, to be safe.
We really have to reevaluate what diversification actually means today. If you look at the numbers, international ETFs have massively underperformed. We're talking an average of maybe 5% appreciation versus nearly double that for U.S. equivalents over the last decade.
That's a huge gap. You are leaving so much money on the table.
You are. But the real aha moment here is that you aren't actually ignoring the rest of the world by skipping international funds. You have to look at revenue exposure versus listing location.
Break that down for me. What does that mean for the average person?
Back in, say, 1980, if you wanted to profit from the German economy, you had to buy a German company on the Frankfurt Exchange. Borders were real economic walls.
Right.
But today, look at the S&P 500. You've got Microsoft, Starbucks, Apple, Walmart.
Oh, I see where you're going. I mean, I was in Tokyo a while back, and I swear I saw more Starbucks there than in my own neighborhood.
Exactly. People in Asia are using Windows. People in Europe are watching Netflix. When you buy these massive U.S. giants, you are buying global market share.
So they're international companies. They just happen to have their headquarters in America.
That's it. You get the global exposure through the best managed companies in the world without the drag of those slower moving foreign markets.
Okay, that makes a lot of sense.
Yeah.
So we are stripping the portfolio down to the studs. No bonds, no specific international funds. Let's build a machine. What is the foundation of this 4 ETF strategy?
The first ETF is your absolute bedrock. The source refers to them phonetically as VUVO, which is VOO, the Vanguard S&P 500 ETF, or SPYM from State Street.
So just standard S&P 500 trackers.
Yes, they are basically interchangeable.
The 500 biggest companies in the U.S. It's the classic benchmark.
It is, but I really want to highlight why it works so well as a foundation. It isn't just a list of 500 companies, it's a self-cleaning mechanism.
Self-cleaning, like my oven is supposed to be.
But this actually works. Think of it as corporate Darwinism. The fund holds the top companies by market cap. If a company starts to fail, think of Blockbuster or Kodak back in the day, its value drops
And it falls out of the top 500.
and gets kicked out of the fund automatically. You don't have to read the news or decide when to sell the loser. The index does it for you.
And a new rising star just takes its place.
Automatically. You are mathematically aligned with the winners. Right now, it's heavy on Nvidia, Apple, Berkshire Hathaway.
And what kind of return are we looking at for that baseline?
Since inception, SPYM has seen an average appreciation of over 11% per year.
11% is solid. That doubles your money roughly every 7 years.
Right. It's comfortable, but this guide isn't about just being comfortable.
We want to optimize. We want great.
Exactly. Which brings us to the rocket fuel. The second ETF is QQQM.
QQQM. Okay, I know the famous Qs, just QQQ. Is this related?
Very closely. It tracks the exact same index, the NASDAQ 100. So that's the top 100 non-financial companies on the NASDAQ. But the recommendation is specifically QQQM because of that M at the end.
What's the difference?
The expense ratio. QQQM costs 0.15% per year to hold versus 0.20% for the standard QQQ.
That sounds like a tiny difference.
Yeah.
Does 0.05% really matter?
Over 20 or 30 years of compounding, absolutely. That tiny difference can equal thousands of dollars staying in your pocket instead of going to the fund manager.
So it's like buying the generic brand medicine. Same exact ingredients, but a fraction of the price. Okay, so we're saving on fees. But why are we adding this specific fund on top of the S&P 500?
For high-octane growth, over the last 10 years, QQQM has had an average yearly appreciation of over 19%.
19%. That is nearly double the S&P return.
It is massive. But there's a trade-off. This fund is heavily concentrated in tech and AI. We're talking Palantir, Google, Nvidia again, but in much higher concentrations.
So if the S&P 500 is a nice diversified dinner plate, QQQM is just a giant pile of steak.
A giant pile of steak that might give you a heart attack, yeah. It's the upside play. It goes up fast. But if the tech sector takes a hit, this fund crashes much harder than the broad market.
So we have our foundation, which is safe-ish, and our rocket fuel, which is risky but incredibly fast. Before we get into how we keep this whole thing from exploding if tech crashes, we want to take a quick second.
Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
Yes, please do. We love seeing what you guys want us to dig into next. Okay, so back to the portfolio. We have growth, we have stability, but if I am putting my life savings into this, I need a shield.
You need a shield.
I do, because I don't want to be panicking if AI turns out to be a bubble.
And that brings us to the third ETF, SECH. That stands for Schwab U.S. Dividend Equity.
Dividend equity. So these are companies that pay you cash just for owning them.
Exactly. But the context here is crucial. The source emphasizes SCHD specifically for the 2026 economic landscape. This is a very specific macro play.
Why 2026? What makes right now so special for dividends?
Well, think about the last few years. High-yield savings accounts have been paying 4, sometimes 5%. It's been incredibly easy to just leave cash in the bank and feel smart.
Oh, risk-free money. It's been fantastic.
Right. But the expectation is that the Fed chair is going to cut rates significantly in mid-2026. And when that happens, that easy 4% from the bank is going to vanish. It might drop to 2% or even 1%.
And if inflation is still hovering around 3%,
You are actually losing purchasing power.
exactly,
So leaving money in the bank becomes a losing game.
precisely. And right now, there are trillions of dollars sitting on the sidelines in those cash accounts. When rates drop, that money has to move. It has to go somewhere to beat inflation.
It's going to go hunting for yield.
It's going to flood into dividend ETFs like SCHD. These funds hold boring companies, Chevron, Pepsi, Home Depot.
Not the AI high flyers.
No, these are recession-proof businesses that generate cash flow in literally any economy.
Boring is beautiful when the market gets scary.
It really is. SCHD has lagged a bit recently because it doesn't hold NVIDIA,
Yeah.
but that is exactly why it's recommended now. It's undervalued. It offers serious downside protection. If the tech bubble bursts, people are still going to buy toothpaste, they still buy gas, they still fix their homes.
And SCHD holds those exact companies.
Yes.
Okay, so we have the foundation, the growth, and the safety. But there is a fourth fund. And the source called this one the unicorn, which honestly I had to read twice to wrap my head around. It's called SPMO, the Invesco S&P 500 Momentum ETF. This is honestly my personal favorite part of the strategy. It uses a factor called momentum investing.
Momentum. That sounds fast, but isn't that just chasing what's hot? I mean, are we always told not to do that? Buy low, sell high?
It is chasing, but it's systematic chasing. It takes all the human emotion out of it. SPMO tracks the top 100 companies from the S&P 500 that have the highest upward price momentum. Basically, it buys what is already winning.
So it's like jumping on the bandwagon, but using an algorithm to decide which bandwagon is moving the fastest.
That is a perfect way to put it, and it rebalances every 6 months. If tech is hot, SPMO buys tech. But, and here's the magic, if tech crashes and, say, energy stocks start rising, SPMO automatically sells the tech and buys energy.
So it's totally agnostic. It doesn't care what the company actually does, only that the line is going up.
Exactly. It has no loyalty to any sector. And the stats from the 2022 crash really prove why they call it a unicorn.
2022 was rough. Basically, everything went down.
It was. The tech-heavy QQQM dropped 32%. Even the safe S&P 500 dropped 18%. But SPMO, it only dropped 10%.
Wait, really? It dropped less than the broad S&P 500.
Significantly less. Because in 2022, when tech was crashing, energy and defense stocks were going up, SPMO had already systematically shifted into those sectors. It adapted faster than the broad market ever could.
Okay, but what about the upside? Because usually things that are safe during a crash don't grow very fast during a bull market.
And that's the magic trick. Its average growth is around 18%, which is almost as high as the pure tech fund.
So you get the upside of a risky fund, but way better downside protection than a safe fund.
Yes.
Okay, that really is a unicorn.
It creates this incredibly unique balance. It captures growth wherever it is happening, not just in the tech sector. It essentially covers your blind spots.
So we have all the ingredients on the counter now. We've got SPYM for the base, QQQM for the tech growth, SCHD for safety and dividends, and SPMO for that momentum magic. But you can't just throw them all in a pot in equal amounts. What is the actual recipe here?
Right. The allocation is key. The source outlines 3 specific personas. Because a 25-year-old should not be investing the exact same way as a 70-year-old.
Of course, your risk tolerance totally changes as you age. So let's start with profile 1, the accumulator.
This is someone with a stable job, far from retirement. They have a long time horizon, so they can handle some bumps in the road. Their primary goal is aggressive growth.
I'm guessing they go pretty heavy on the rocket fuel.
They do. The allocation for the accumulator is 30% SPYM, that's the foundation, 25% SPMO, the momentum, 25% QQQM, the tech growth, and only 20% SCHD for safety.
So 75% of the portfolio is geared toward pure growth with just a 20% safety net and dividends.
Correct, but there is a very strict, non-negotiable rule attached to this. This person must have an emergency fund of 3 to 6 months of living expenses in cash, sitting completely outside of this portfolio.
Right, because you do not want to be forced to sell your stocks if your car transmission blows up or you lose your job.
Exactly. The stock market is for building long-term wealth. Cash is for life's immediate surprises. If you are forced to sell during a market crash just to fix your car, you lock in massive losses. That cash buffer prevents that scenario.
That is smart. Keep the investments protected from daily life. Okay, what about profile 2, the pre-retiree?
This is someone who is maybe 10 years out from retirement. They still need upside to grow that nest egg because inflation is very real, but they cannot afford a massive 40% drop right before they hand in their resignation letter.
So they need to secure the bag a bit more, dial back the risk.
Exactly. Their recipe shifts. It goes to 25% SPYM, 25% SPMO. We drop QQQM down to 20%, and we bump the SCHD safety layer up to 30%.
So increasing the safety, trimming the volatile tech exposure.
Right. And the emergency fund requirement goes up as well to 1 full year of living expenses.
The full year in cash. But that makes sense because if you lose your job at 55, it might take a lot longer to find a new one than it would at 25.
You definitely need a longer runway.
Okay. And the final profile. Profile 3, the retiree. These are the people actively living off this money.
Here, the entire goal flips. We aren't trying to get rich anymore. We are trying to stay rich. The absolute priority is wealth preservation and income generation. You cannot afford to lose the principal.
So how does the recipe change?
It shifts dramatically. 50% goes right into SCHD.
Wow. Half the entire portfolio in the dividend fund.
Yes. This is to mitigate sequence of returns risk. That is the danger of the market crashing the exact year you retire. They need that steady cash flow from dividends to pay their bills without having to sell any actual shares.
And the rest of the portfolio.
25% SPYM, 15% SPMO, and only 10% QQQM.
So just a tiny sprinkle of tech for a little growth, but overwhelmingly focused on safety.
Precisely. And the emergency fund here is massive. 3 years of living expenses in straight cash.
3 years. That is a ton of cash just sitting around doing nothing.
It is, but think about the psychology of it. If the market crashes for 2 years straight, like it did in 2000 or 2008, you don't have to sell a single share at a loss to buy groceries. You just live off the cash reserve. You let the portfolio recover on its own timeline. It essentially makes you bulletproof against market cycles.
That is a really solid strategy. It takes all the emotion out of it. You aren't waking up and checking stock prices every morning in a total panic.
And that is the core philosophy of this entire guide. It is simple, it's low fee, and it has high growth potential. It completely eliminates the stress of stock picking. You aren't sitting there trying to guess if Tesla had a good quarter or if Apple's new headset is going to be a flop. You are just betting on the underlying market mechanics.
And I really think that momentum concept with SPMO is the game changer for 2026. It feels like a very modern way to handle volatility without just hiding all your money under the mattress.
It really is. And I think it challenges everyone listening to really take a hard look at their own portfolio. We hold on to these old ideas like always hold bonds or always buy international just because our parents did it or because some finance textbook from 1990 said so. But the data clearly suggests that in a digital, globalized economy, the rules have fundamentally changed.
A strategy that takes 5 minutes to set up and actually beats the market. I will take that deal any day of the week.
It is incredibly compelling. And here is one final thought to chew on. As AI starts running more and more of these institutional trading algorithms, does momentum investing become even more powerful? Or does it eventually become the only way to keep up with the sheer speed of the market?
Oh, that is a slightly terrifying but fascinating thought to end on. Well, that brings us to the end of this deep dive. We really hope this gave you a clear roadmap for the year ahead.
Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling.